First of all, my sincere thanks to the Corporate Laws and Corporate Governance Committee, the chairperson, Shipriya, and the chairman and other office bearers of Tirupur branch of SIRC of ICA for giving me an opportunity to present a paper on this 5-day refresher course on company law matters. I have slightly modified the topic because it was a little aggressive on ONSLAUGHT and all those things. So I have just made it as a typical chartered accountant who provides what I must say that solution rather than fighting with the regulators. So I made it as how to face compliance and regulatory challenges by chartered accountants. So slightly I have modified, but the content is what you want to have it.
Okay, sir.
And when you had the session on Schedule 3, when you had the session on CARO 2020 by Sripriya, you may have a little bit of feeling that whether we will be able to face this regulatory challenges or we have any tools available for protecting ourselves in case of some sort of proceedings initiated against us, maybe by the regulator, FRRB, or maybe NAFRA, or Institute on Disciplinary Committee, or a technical review by the Registrar of Companies, etc. How we will protect ourselves is what the Company Law Committee is looking for to help the chartered accountants in practice. But it is not only stopping at the chartered accountants in practice. In my view, it also goes to help the chartered accountants in industry so that they will be able to manage the various regulatory challenges, various compliance related challenges, because they are also one of the target. Primarily, the management is responsible for preparation and presentation of the financial statement, and then only starts the role of the auditors. And accordingly, I believe that there is only a thin line of difference between what is the role of auditors and what is the role of the management. Especially after hearing Sripriya on CARO 2020, I tend to have a feeling that the role are going to complement each other. When you are presenting something on Schedule 3 as part of the financial statement by the management, and the auditor is going to validate the statement given by the management and express his independent opinion, I think that both has to align their thinking in a proper manner. If there is a discrepancy between the two stand taken, the company will be in trouble, the management will be in trouble, the auditor will equally be in trouble. So that's the reason why how to face the compliance and regulatory challenges becoming an important role to look at. Whenever I'm talking, I always have a feeling that there are three important questions, or maybe three big questions, which always comes to our mind as part of our role as either in practice or in industry. The first thing which we are having is so many regulatory changes are happening. So many amendments are happening. So many notifications are coming in. So many circulars are coming in. In such a situation, how it is possible for us to ensure that we will be able to comply with the rapidly changing laws and regulations? The question also comes along with that is it the role of the management or is it the role of the auditors when we are talking about the rapidly changing laws and regulations and their related compliance? Here, I stop for a moment and say that even though the primary responsibility is with the management to comply with the laws and regulations, surely there is a role to be played by the auditors, because the auditor is commenting on non-compliance of laws and regulations. For example, CARO 2020 is a statement of fact on whether you have complied with a specific requirement or not. If it is not, what is the level of deviation? So how I can ensure means the auditor as well as the management has to ensure the rapidly changing laws and regulations to keep themselves completely relevant and updated with the changes which are happening. Previously, if somebody is calling me for giving a presentation, I normally share my presentation as the background material well in advance. Nowadays, I am having my own worry. If I share something and later on there is an amendment before the actual date of presentation comes in, how I will accommodate. That's the reason why even in a case of a presenter, we have having a feeling that we should always look at what are all the changes up to yesterday midnight and what is applicable today and how we are managing it. Okay. So that is the first big question which is coming to our mind. The second important point is, as an auditor, I am responsible for ethical and transparent financial reporting. We are very sure that the financial reporting is to be done by the management, but at the same time, are we in some way or other responsible for ethical or transparent financial reporting? In my view, surely that is the role of the auditor. By making an opinion on the financial statement, maybe we can say that the primary objective is to say whether the financial statements on a whole contains any material misstatement due to fraud or error. That's maybe fine. But when we are looking at that, the ultimate idea is to see that the financial reporting is transparent and it is also ethical. It doesn't contain any material misstatement, or it doesn't contain a misreporting or underreporting or whatever name you call. So this is also a role to be played, or expected role to be played by all the regulators on the part of the auditors. And the third one is, suppose I have not carried out these two activities in my role as an auditor, and because of that, there are some small issues which came in. For example, if I'm supposed to report on something relating to a clause in CARO 2020, or I have to validate the compliance with a particular accounting standard, or a compliance with respect to some sections of the Companies Act. When I'm supposed to do that, I'm also supposed to look at whether there is any possible management override of control. And we are saying management override of control, to put it in simple terms, 365 days the control is working, well established internal control system. But on the last day, the management wanted a particular profit or particular top line for which they are asking the finance controller or the CFO to make some adjustment. Maybe for tax purposes, maybe for investment being pulled in by the management from the outsiders. For that purpose, there may be some pressures and on which they will be doing it. If I am also part to that particular activity, and if it is exposed at a later point of time, whether I will be able to face the public with the same pride which I am having in my mind. That's a question which we are always having. See, for example, if any news is coming relating to, maybe I can say that anti-corruption or any other fraudulent reporting in which a particular form of chartered accountant or particular name of the chartered accountant is appearing in the newspaper, how much embarrassment they will be having in their personal life, social life, and professional life. So accordingly, definitely we will not be comfortable if the action or the result is made public after we have not looked at any audit with to ensure compliance with laws and regulations, the ethical and transparent reporting. That is exactly where the regulators are looking at us and trying to find out whether we have done it. And unfortunately, there is a problem with the regulators is that they always think that if we have done something, that is a completeness of the entire work. Or maybe I can say that they are putting the auditors into such a high esteem by saying that if the auditors are signed, the financial statements are completely perfect. Unfortunately, they know that perfection is only left to the God and not for the human being. And the audit procedures are having their own limitations. If there are some limitations, and because of that, I could not find out that doesn't mean that I'm intentionally biased with the management. Maybe something which might have gone wrong in my audit approach. Systematic failure, or the procedure failed, or it is an orchestrated fraud, whatever could be the possibility, right? And management may be not intended to do anything, but unfortunately, in some cases, there is a mistake which went unnoticed both by the management and by the auditor. Again, there is an issue. So what is happening is that there is an expectation gap when we are supposed to look at. For example, the actual expectation which is supposed to be had is external auditors has to provide an independent opinion on the financial statement of the company. That means if I am comfortable, I give an opinion saying that this financial statement does not contain material misstatement. Even I am not saying that it does not contain a misstatement. It does not contain an error. I am not saying that. I am only giving a reasonable assurance. In fact, if you see the format of the audit report, you will see that we have explained what is meant by reasonable assurance. So we are very clear in what we are providing. Unfortunately, the expectation is completely different from the users. In fact, there are some reservations also we have, or maybe I can say that there are some areas where I could understand that the reservations or maybe the limitations which we are having as far as the audit is concerned is that if you see, the real challenge is that when we are doing an audit or when we are completing an audit, we are completely relying on the information provided by the management. That is the reason why even in the first stage of audit in 143 subsection 3, they are saying, have we sought and obtained all the information and explanations required for the purposes of our audit? We are making it very clear, right? Because the information is handled by the management, but the perception which the regulators are having, whether it comes to legal matters or it completes a compliance matter or it comes to regulatory matters, or even if there is a scam which is actually burst, the perception is that external audit is being investigative in nature. Please understand that they are believing that when you are doing an audit, you are doing an investigation. Even last week, we had a session on Schedule 3 and CARO 2020. There was a chief guest from the government side, and he was making it very specifically that auditors are investigators. Unfortunately, we have to tell them the investigation is a special audit and not a statutory audit. Investigation is finding the issues and then identifying what could be the damage which has happened. Whereas the audit is not that. It is an expressing an opinion on the financial statement. But having said that, the perception is always that we are doing an investigation during the course of the audit. And accordingly, we should have found out that all information or all mistakes, all non-compliances, all regulatory issues should have been identified by the auditor and presented to the stakeholders. One of the challenge which we are always having for a bigger companies, smaller companies, in my mind says that nothing is to worry too much because we directly connect with the directors, we directly connect with the board members, and sometimes we directly connect with even the managing director of the company. But in smaller companies, what normally happens is your control, or in bigger companies or mid-sized companies, you are having a problem is you normally work along with the CFO, and occasionally you will interact with the directors, and very occasionally you will make a direct connect with the audit committee for bigger companies, listed companies. The problem is the audit committee works with their own system, and accordingly they have to do a lot of activities assigned to them. And one of the activity is to look at what the auditors have observed. So this is maybe a 10 minutes presentation at a big audit committee. I still remember that when I was part of one big organization as a partner, we have prepared a presentation on what are all the observations made by the auditors according to the requirement of standards on auditing. We are supposed to make a presentation to those charged with governance. That means to the audit committee, and the audit committee will take those items to the board. This is the normal scenario. Audit committee chairman reached 15 days after the allotted time. So there was a delay. And after he came, he looked at the audience. One of the director was from a tire manufacturing company, and the audit committee chairman started having a dialogue with them, with that particular director. The discussion was for the next 20 minutes. The audit committee chairman is having a old Rolls-Royce vintage car, and its tire broke, and how to replace with a reasonable alternative. That discussion went on for 20 minutes. Maybe they felt that that is a more serious affair than the audit and adoption of accounts. And after that, the presentation of CFO has happened. Finally, they have said the auditors are also present and they would like to make a presentation. So when I opened the presentation, there was one messenger came saying that the board members have already reached and the audit committee is expected to complete in another 10 minutes time. So whether any delay will be there, they wanted to understand. The messenger, when he has came and told that, the audit committee chairman said that, sir, we know your audit procedure. நீங்க ரொம்ப நல்லா ஆடிட் பாப்பீங்க சார், எங்களுக்கு உங்க மேல எந்த இதுவுமே இல்லை. அதனால நீங்க உங்க பிரசன்டேஷன் ஒரு 2 மினிட்ஸ்ல முடிச்சிடலாமா? மை ஸ்லைட்ஸ் வர 24 ஸ்லைடு. 24 ஸ்லைட 2 நிமிஷத்துல முடிக்கிற வித்தையை வந்து எனக்கு தெரிஞ்சிருந்துச்சுன்னா நான் என்ன மாதிரி ஒரு செஷனையும் என்னால ஹேண்டில் பண்ண முடியும். Unfortunately, it is not. Finally, we have wind up with 1.5 minutes by saying that, okay, these informations have been already shared with the CFO and we got the thing also. We will leave the slides for the benefit of the audit committee and for the board. And you can circulate to the board. So fortunately, we have took a printout knowing that that could be a possibility. Why I'm saying that is, unless we create a direct channel with the audit committee, sometimes the challenges will be we are not able to meet the expectations of the stakeholders. And finally end up with having a blame that we have not done an audit properly. So that is where we have to be a little cautious. Added to this, there was one observation about auditors' independence. Whether the auditors are independent, even though we are giving an audit report, independent auditors report. எனக்கு கூட யோசிக்க தோணும் சில நேரத்துல, ஆடிட் ரிப்போர்ட்னு சொன்னா போதுமே, அது என்ன அழுத்தம் திருத்தமா இண்டிபெண்டன்ட் ஆடிட்டர்ஸ் ரிப்போர்ட்னு சொல்றீங்களே அப்படின்னு. ஸோ என்ன நானே நான் சொல்லிக்கிட்டு நான் இண்டிபெண்டன்ட் இல்லைன்னா எனக்கே சந்தேகம் வந்துருமோ அப்படின்னு பயப்படுறான்னு நினைக்கிறேன் ரெகுலேட்டர். So the regulator, when they are having a feeling that about the auditor should be independent of the audit client, especially when it comes to smaller cities or tier 2 cities, where our relationship with the client is a long drawn relationship, maybe started with the tax work and then slowly it has become a corporate audit as well. At one point of time or otherwise, what will happen is that we are sometimes trying to find a solution to the client rather than acting completely as an independent auditor. Maybe they are having a feeling that the auditor's independence is actually not being properly looked at. That is the way in which their observations are. These are all the actual observations made by the regulators. Auditor's responsibility is not limited to the shareholders, and audit report is a public document. Even if you are giving an audit report to a private limited company, the regulators are thinking that auditor's responsibility is not only to the shareholders, the entire public who are relying on the audit report is considered to be the stakeholders for this particular thing. Even if you may be giving a audit report for a private limited company, and that private limited company is submitting the financial statement to the bankers for having taken a loan. I have seen cases. In one of the case, the auditor took over the audit for the first year. Previous 3 years itself, but 3 years before that itself, that account became an NPA. When the bankers have gone for filing a case about the management, they have added the new auditor also as part of the respondent to the notice, saying that based on the audit report issued by this auditor, they have given the loan to the company. And accordingly, the auditor never alerted. That type of perception is actually there when an audit report is issued. So they are questioning the independence of the auditor. You are expected to be completely hold of that. That's what they are saying. Audit report is relied by various stakeholders. They are not stopping various stakeholders. Who are? They are saying including financial institutions, including the government, including the general public. Accordingly, even though the management appoints us and we are ready to accept an audit for a fee which may not even commensurate with the size of the work which we are doing. That's the reason why I normally say that உலகத்திலேயே ரொம்ப பெரிய philanthropist யாருன்னு கேட்டோம்னா சார்ட்டர்ட் அக்கௌண்டன்ட் ஃப்ரெட்டர்னிட்டின்னு சொல்லுவேன் நான். ஏன்னா we never maintain our cost sheet. What is the number of hours you are spent and what is the time and what is the cost for that time which you have spent compared to what is the fees you are collecting. We never do that activity at all. And if you start doing it, உழுதவனுக்கு கணக்கு வராதுன்னு சொல்லுவாங்க. இந்த உழவு பார்த்த கணக்கு கிடைக்காதுன்னு அதே மாதிரி ஆடிட் பார்த்தவனுக்கு அந்த கணக்கு இருக்காதுன்னு தான் என்னுடைய ஃபீலிங், பர்சனல் ஃபீலிங். But when we are doing that work with a very, very small audit fee, the responsibility is actually increasing because the regulators are feeling that your audit report is relayed by the government, relayed by the financial institution, relayed by the general public, and accordingly you are answerable to everyone, right? And another thing which they are saying is, they are blaming the auditors that auditors' financial and other interest in the client's business inappropriately influence the judgment or behavior. This is happening in certain cases. Section 144 of the Companies Act also very particularly talks about that the auditor should be very independent. What it says that if you are having any financial relationship, indebtedness, security, guarantee, or business relationship, you're a partner or direct by some pecuniary benefit is coming because of a particular business of the client, naturally your independence is being affected. This is acceptable, right? That is the reason why we are ensuring that we are not connected to the client. In fact, we have gone to the extent of even previously people used to say, my client is having some property in some hill resort and I will go and stay. Nowadays, we are ensuring that if we are trying to use that facility, first thing is whether the client is giving a tax invoice and we are paying the tax invoice. That's the way in which we are trying to find it out. Because nobody has to blame us saying that we will get influenced. Another thing which they are saying is that this is, of course, in my personal view and my personal experience, I can vouch that there will not be any basis for it except in exceptional circumstances where the audit fees is exorbitant. And because of that, the auditors are not interested in losing the client. They are losing their independency, or maybe they are having a biased view, allowing the client to have a safeguarding. For example, if my audit fee from one particular client is said, say for example 50-60 lakhs, my total fees itself is only 70 lakhs. Naturally, I will be tend to make some sort of alignment with the client is what their observation is. But if we really look at, we will not have that type of independence threat, but we have to be a little cautious if you are looking at your own client list and who are all the major clients, and for the major clients, what type of precautions we are taking up is an important point. Income from other services provided by the auditors also affect how far the auditors may be influenced by the management. You might have heard live cases, you might have seen. Majority of the cases, even one of the very recent quality review report which has been issued by the NAFRA, National Financial Reporting Authority, on one of the audit firm, they have mentioned that they have done advisory activity as well as the audit activity. Because their advisory fees is much higher than the audit fees, the advisory partner has influenced the decisions of the audit partner. That was the observation. Very, very damaging observation. Of course, that firm is actually fighting that it is not the case. That is totally different. But what normally happens in our cases is that we may do certain activity inadvertently which are not permitted according to the law. For example, in a Mapsal area, sometimes you are going to the extent of even maintaining the books of accounts for some of the clients. But if you are maintaining the books of accounts and you are doing the audit, you are doing the work of audit of your own work. That is the reason why they are saying, what are all the other services which you are doing? In fact, because this particular allegation has come, one good thing has also happened, which I must tell you, is that bigger audit firms are now delinking audit services and taxation services. So they don't want to do the tax work relating to statutory audit client for a simple reason. Their view is that audit is different and tax related work, advisory, litigation, etc. are different work. And because my services is also considered as part of the services, they are believing that it has to be delinked, because some of the amendments which they are proposing is to delink the tax related litigation work and advisory work from the statutory audit. That should not be done by the same audit firm. They are planning it. So it creates a new avenue for us to look at this aspect as well. Some new avenues. Statutory audit we might be losing for other big firms, but we will get tax related work where we are very stronger. This is interesting work. They are saying sometimes, this is also another case, maybe it is applicable to us also. We quote competitive fees because we wanted to ensure that we are winning the client. But that fees is not commensurate with the amount necessary to provide a quality audit. In fact, one of the company in which I was, I'm the audit committee chairman. It is not auditor, but it is a secretarial auditor. They have floated the tender. One of the secretarial auditor has asked for, you will not believe that fees, 6,400 for a listed company having a turnover of 1,500 crore for doing a secretarial audit work. Even if you are spending one day along with our assistant, that may not be there. For example, even when I have assigned a job for physical verification to some of the remote locations for my MNC client, we have paid for spending half a day 7,500 rupees for an audit firm and as an outsourced activity for a simple physical verification observation, not even actual work. Whereas the secretarial audit certification, they are charging 6,400. The reason why they wanted to charge, when we have asked, they said that in our profile, we wanted this company to be there. Okay, perfectly all right. And second is, what is the time you will spend? They are supposed to spend 3 weeks of time minimum according to the tender. They are ready to spend. And out of the 3 weeks, 1 week should be by a qualified company secretary who is holding the COP. They have said, yes, we will do. So in such scenario, how you can expect that the quality can be maintained according to the requirement? Because sometimes your fee will be detrimental for doing a proper job, right? So a balancing act between what is the very high fees and what is the very low fees, you should strike a balance. What is commensurate with the size of the work and what type of expectations are there, how you are managing it is what is really important. The role of the auditors are changing. In fact, these are all some of the statistics or maybe research which has said that the expectation of the companies, the expectation of the stakeholders is that auditors, rather than doing prevention and detection of errors, etc., which is only 30%, they are believing that auditors should be a solution provider as opposed to finding fault and errors. In other words, they are expecting that when you are doing an audit and you are observed there is an issue, what type of solution can be provided for that particular issue within the four walls of law. Of course, we are not trying to find out some sort of innovative ideas, which is tax evasion, which is non-compliance, etc. We are trying to find out what is an alternative approach which could be possible within the four walls of law. And that is the role which is changing or emerging. And I believe that if we are aligning to that type of expectation, naturally, we can face the challenges of regulatory and compliance environment rather than doing a routine audit of a normal process. That is what my personal feeling. For example, when you are doing a value-added services to your client, when you are providing insight into what could happen in the next few years, what are the changes which are happening, For example, we are making a presentation to all our clients, whether small client or bigger clients. What are all the regulatory changes which are going to happen in the next 6 months and how that may have an impact on the company's operations? We normally make that particular assessment. Even it may be one single slide or two slides, but the client is so comfortable when we are doing this. They are expecting that they wanted to learn something additionally, how it will have an impact on their business, right? And of course, the other activity. The regulatory changes, if you see, Schedule 3 is amended, which is effective from this particular financial year. A lot of things which has to be looked into. And corresponding to Schedule 3, there is an amendment in company's auditor's report. In main audit report also, there is a change. In your company's auditor's report order 2020 also, there is a change. And this changes when you are reporting, you have to evaluate whether your main audit report is also requiring a modification or any reference is required. So it is all interlinked. I used to say, when you are giving an audit report, you should also look at what is the presentation given by the management in the financial statement and how your report is also balancing with that particular activity. SEBI has changed a lot of listing requirements with respect to listed companies, and the CSR requirements is also changing. And in Tirupur, I believe that most of the companies will be making good profits, and because of the profit element of 5 crore or more, they will get caught into the provisions of Section 135 of the Companies Act. CSR is mandatory now. If there is an unspent money, it should be either transferred to the special account if it is an ongoing project, or it should be transferred to the special account maintained by the government if it is other than ongoing project. So the shortfall has to be reported by the company as well as by the auditors. So we are having a challenge there also. Other laws and regulations also changing, which has an impact on this. So when we are talking about the tax audit, the forms are changing. All those things is also another impact which we are looking at. Moreover, the code of conduct relating to audit profession is also underwent change from July this year, right? So July this year is, I'm talking about July 2021. So you have a lot of changes which are happening, which has an impact on the way in which you are supposed to do your work and how the external world is looking at you. Now, let us look at the issues relating to audit issues are now becoming more and more complex. For example, previously we were trying to assess whether client's financial statements are proper. Then came a requirement to see whether the company will be able to prepare the financial statement on a going concern concept, fundamental principles, fundamental assumption. So that is also, we are happy with that. Then came a change. In the audit report, the auditor has to assess and say whether the company will be able to run as a going concern. And now they have brought in a separate amendment in the audit report where the auditor should comment very specifically in a separate paragraph whether there are any material uncertainty relating to going concern in the main audit report. Added to that, in CARO report, there is a clause which says based on the ratios which the company has published, based on your analysis of the financial assets and financial liability, management's business plans, etc., whether the company will be able to pay its liabilities as and when it is due within the next 12 months. So the going concern issue, you have to check. For example, if I'm talking about 31st March 2022, I'm supposed to see whether the company will be able to meet its liability at least up to 31/3/2023. That is a 12 months period which the going concern standard is requiring you to validate, right? If you are not doing that activity, there could be an issue. So you have to look necessarily the going concern assessment for every client. This is aggravated because of your COVID related issues where companies have lost their orders, export orders are on hold. And when we have sent the material, the payments are not coming in, a lot of issues, right? So Tirupur, specifically when you are looking at the going concern assumptions vis-a-vis the COVID related issue, also we have to look into so that we can avoid any possible issues arising on non-compliance or regulatory matters. The second is auditor has to evaluate, not only management has to evaluate, auditor should evaluate what management has declared as a going concern. Now that's what I'm saying. Main audit report as well as Caro report requiring you to report on this. There are problems which companies are used to come because of COVID related issues. They have not operated for a longer period. They have machinery and they believe that depreciation on idle machinery should not be charged. Unfortunately, the standards are not like that. It says a fraction of time should also be considered. Maybe extra shift allowance will not apply. Maybe when you are having molds and dies, where the depreciation is charged based on what we call it as a unit of production method, there is a possibility of idle machinery need not be depreciated. But in all other cases, it's required. Property, plant and equipment, whether it has to be tested for impairment is one of the biggest issue which we have to consider if the company is making losses and it's not meeting its budgets. So what type of issues are arising out of it? We have to necessarily consider this. And losses relating to financial asset, doubtful debts, slow moving and non-moving inventories, all other financial asset, you have to always look at what is the credit risk arising out of the uncertainties in the world now, in the financial field now. Investments, very common. One company has invested in the group company. They have a chain of companies in the group, and the investments are made by the main company to the other group companies. The other group companies are not functioning properly. To that extent, how the valuation should be reflected in the books of the main company, investee company. All those things are also additional requirement which we have to look into because it's becoming something complex now, not simple. And this particular investment in group companies and others also has an impact on your main audit report in the current year because of amendment to Rule 11E and F of the company's auditors rules 2014. There is an amendment. So there also you have to evaluate this particular item. During the lockdown period, during the absence, whether I have incurred any expenditure, whether that expenditure can be treated as deferred revenue expenditure, the answer is definitely a no. And deferred tax asset, some of the companies to show a profit, the profit before tax is actually a loss and profit after tax is a profit. How it is being done? They are recognizing deferred tax asset for the carry forward losses. Be careful that when you are recognizing deferred tax asset, according to accounting standard, there should be a virtual certainty if there is a carry forward losses. India is actually talking about reasonable certainty, but here it's a virtual certainty. And accordingly, whenever deferred tax asset is being recognized for a loss-making company, you have to be a little cautious on that particular activity, and auditor should look into that particular area as well. And of course, every valuation of investments, whether there is a diminution other than temporary, has to be considered. If it is a current investment, what is the market value? What is the value which you are stating in the books of account? Whether any provision is required or any write-down is required. These are all the things which are becoming a complex issues which are added to the normal activity which we are doing as part of our audit approach, right? So it's becoming more and more complex. We normally miss certain items in our assessment. That is what I am trying to bring it as for our notice. For example, in the audit planning, we often miss this. Because of that, we are not able to face the regulatory challenges, regulatory questionnaire. We are not able to challenge it. For example, when we are talking about the audit is, first of all, start with understanding the client's business. The audit has to make a risk assessment. The audit should also look at what is the internal financial control system, based on which what is the level of verification of vouchers and other substantive procedure is required. When you have assessed a risk, have you responded to the assessed risk? What is your audit procedure for each of the risks which you have identified? And how you are going to perform your audit procedure? Is it simple vouching, or you are going to do an analytical review, or you are going to do a physical verification of document? All those things are depending upon the nature, timing, and extent of audit procedure relating to a particular test objective. And have you collected sufficient appropriate audit evidence? On that basis, sufficient appropriate audit evidence being collected, you are expressing an audit opinion, right? So in simple terms, before I go to expressing an audit opinion, I'm supposed to look at various aspects as part of my planning and execution. If I miss this, definitely my outcome will be questionable, right? If the outcome is questionable, there could be an onslaught which is coming from the compliance and regulatory perspective. That is where we normally say that we can do this in our audit approach or audit planning. First, you are supposed to look at what is the risk relating to the particular client's business. For example, if you are talking about a simple case of Tirupur Industries, the main aspect for Tirupur Industries are they are mainly export oriented or garment manufacturing or knitted garment manufacturing. And so what are all the things which could be a risk assessment which I have to consider? One, your credit risk when you are talking about export, how the risk is being managed. Have you got a letter of credit to ensure that your receivables are properly being done? The second is being export market, you are having the issues relating to fluctuation, right? Exchange rate fluctuation. That is another risk which you are identifying. The third risk which we are talking about is that it's a highly capital intensive unit. So naturally, a lot of capital will be held up on a long-term basis. So short-term investment purposes, when I have raised some money, whether it has been invested long-term purposes or long-term use, I have to be very careful about it. Another thing is, it is more of employee oriented or it is more of labor oriented. So how you are managing the labor related availability of labors and the related laws and regulations which you have to comply with. So this is a simple example of how you make the risk assessment for a given scenario. For a simple reason, I'm understanding the client's business, identifying what are all the possible risks and what should be my audit approach for that particular risk, so that my material misstatement in the financial statement and compliance related issues can be brought to the minimum or tolerable level, right? Now, when we are talking about understanding the entity, what is the environment in which it is operating? That is what I have mentioned. Tirupur, I have taken an example. It is operating in an economic environment which are mainly catering to the foreign market or export market. And what are all the internal controls which you are having in your business? In fact, people used to think that only the auditors knows about internal control, but I never think about it. I believe that client is running his business for 365 days with a sole single aim of making it profitable, sustainable, and long-term growth. Nobody is running a business for incurring a loss, right? If they are doing their business, definitely they will know how to control cost, how to control leakages, how to control the possible penalties, fines, etc. There could be some sort of internal controls which they will be having. Understand that internal control is also part of the understanding of the entity. Then I'm saying identify and as risk of material misstatement, where it could go wrong. In respect of fixed assets, it may go wrong. In respect of your borrowings relating to term loan, it may go wrong. In respect of foreign exchange differences accounting, it may go wrong. In respect of provision for doubtful debts, it may go wrong. It may be non-availability of inventory or defective material being done. So rejection could be, it can go wrong. Your labors are not available because of that production is disturbed. Production when it is disturbed, you may incur losses. These are all the possible risks. And in that particular risk, what could go wrong? For example, when the company is incurring huge capital expenditure, my repairs and maintenance expenditure should always be analyzed to see whether only repair expenditure is accounted there or capital expenditure is also charged as revenue, which may go wrong, right? Similarly, when I'm not looking at the trade receivable, which is subsequently collected, Sripriya has also passed a passing comment on that particular area. What is the subsequent development or subsequent realization? When you are working out, you will know whether the provision is required or not required. In one of the client case, we have seen that the finished goods has increased to 3 times compared to the previous year. When we asked, they have said some of the orders which they have received from the client during the COVID period has got cancelled. Because of that, the finished goods has accumulated. Then immediately the next question we are asking to assess the risk is there any alternative market for that particular item? What is the aging of that particular item? What you have done with the subsequent sales of that particular item? Is it realizable at the manufacturing cost at least, or it should be returned down to the net realizable value, or it should be completely scrapped and provided for? This is the way in which you have to look at understanding the entity, environment, and the various key risks which is associated with that. Because the material misstatement can happen on fraud or because of error. Equally, the impact could be there. Fraud, to my mind, I believe that 90 to 95% of our clients, we can simply say that the integrity is not questionable. Having said that, we have a mantra, or maybe I can say that a tagline: trust the client. Because you are working with the client for years together. You know their integrity. You know their tone at the top. And accordingly, nothing to worry about their ethical reporting. But at the same time, trust the client, but verify. Because you are expected to do your audit procedure to conclude what you have assessed, that there is no possible fraud which has been committed. Error is maybe a failure because it's unintentional. You are expected to find the errors and correct it as part of your audit role. That is the reason why you are talking about materiality, your test procedure, etc., etc. In fact, when we are talking about fraud, people are having a feeling, especially regulators are having a feeling, that the auditor should always ensure that there is no fraud which has happened in the financial statement. Unfortunately, we have only one role according to SA 240. We have to consider what could be the possible area there could be a fraud on the company or by the company. Have we done audit procedure to ensure that the fraud risk has been mitigated? That's a very simple way of looking at it. But the way in which if something goes wrong in a particular company, the first thing is the company has not made the fraud. The auditors have also colluded with the company. That is the type of activity is there. Fortunately, out of my own experience for more than 34 years of my practice, I've seen 95% of my clients, I don't have a question to raise on their integrity, because their understanding with respect to the financial statement is okay. Maybe a little bit of here and there on the tax planning, they will be having some worries, but not to make the investors and other stakeholders completely in dark. They don't want to have that feeling. Maybe 5% of them, because of their issues relating to what we call as pressure of performance, that could be there. But I have seen that it is always there in listed companies and not in smaller companies or mid-sized companies. Okay. So now the next question which we are talking about is, at the financial statement for each of the items, what are all the assertions or what are all the promises? For example, if I am using the word assertion level, you will feel that something unusual. But if I am connecting it with what we have explained for a Tirupur company, when we said in financial statement, we have fixed assets because capital-oriented industry. In fixed assets, whether we have provided depreciation properly, whether we have considered the productivity of the particular machinery and vis-a-vis what is the actual production, whether impairment is there. We are talking about whether the property, plant and equipment is properly valued or not after depreciation. Similarly, when we are talking about the credit risk relating to debtors and provision for doubtful debts, again we are thinking that whether the debtors are properly valued or not. That is a promise. The management promises that yes, what is appearing in my balance sheet is recoverable. What is appearing in my balance sheet will not go wrong. That is what we are supposed to assess and come back, right? That assertion level, we have to link at our audit procedure. If you are doing it perfectly all right, that is what we are saying. At the assertion level, what are all the risks which may happen and what should be my response to that by means of my audit procedure. On that basis, we are ensuring that the risk can be reduced to the acceptable level. When I have explained all these things without mentioning from where I am talking about, you might have understood that knowingly or unknowingly, we are using this for years together. Years together, we are doing this. Actually, this is coming from SA 315, assessment of risk relating to material misstatements. In simple terms, I'm saying our common sense is actually making us do all this activity, but we are believing that we have not done it. I will come to that, why we have not done that, or why the stakeholders are believing that we have not carried out our activities properly. We'll look at in another 2 slides after that, we will see. We often miss relating to the audit procedure. We should understand what is the laws relating to that. We should ensure the compliance relating to accounting standard. We should ensure that what type of audit procedures can identify that. For example, if I'm saying that the fixed assets are physically verified, can I validate by means of looking at the document? No, I should actually look at what type of physical verification the management is engaged. Can I also participate in that particular activity and understand that it is within that requirement? For example, in CARO 2020, there is a specific requirement. There is a specific requirement in CARO 2020 which says very, very clearly that the previously in inventory, they are talking about whether the inventory has been physically verified by the management at reasonable intervals. Frequency of that verification is reasonable is what is the previous question. Now they are asking whether the procedure followed is appropriate to the size and nature of the business. Completely changing. The English changed and the expectation is also completely changed. That means you should see the procedure adopted by the management is acceptable or not, whether it takes care of all the possible issues. Then comes significant estimate. In a smaller audit, your estimate will be maximum gratuity provision or leave encashment provision or provision for bonus, etc., or maybe provision for doubtful debts. Other than that, no significant estimate will be there for a smaller and medium-sized audit. Fraud risk, as we have already said, that there is a responsibility cast on us which we have to look at. And in some cases, we are relying on the work of other experts. Even actuarial valuation, we are relying on the work of other experts, which we have to look at. And where we are actually missing is, for having done all the activity, have we documented our work properly? That is where we are actually missing. When it goes to the regulatory perspective, some disciplinary action or proceedings has been initiated and they are calling for our work papers. We are blinking because we don't maintain proper work papers showing that appropriate audit evidence has been collected before we have issued the audit opinion, right? How we can mitigate this? If we do the risk assessment, we can do that looking at the environment, what is the financial performance of the company, what type of industry, what type of regulatory or external factors which will impact the way in which the company is operating. For example, in Tirupur, I'm sure that you will always look at the pollution control related issues, because a lot of units might have been closed down just because they are not following the compliance with the pollution related. So that type of regulatory issues also has a risk for the company's performance as well as company's continuation as a going concern. What type of entity is it? Is it a partnership firm, proprietary firm, company, private limited company, public company, subsidiary of a public company, a listed company? Depending upon that, the complexity or the risk assessment and the level of activity which you have to do will also increase. And what is the objective of the management? Management will always look at running a business on a profitable manner, sustainable manner, maybe generation to generation to generation, they wanted to have it. And it's a classical example. Places like Tirupur, we have seen that it's a family business which is running for generation to generation, right? So how they are ensuring that the objectives of the management is being met and what type of accounting policies they are using. Is it in line with the required accounting standard or financial reporting framework? And what type of performance which they have done it? They are doing the business for 10 years only at loss. And what is the meaning of running that business? Is it any other reason why that business is being run? Or when the company is thinking about turning around? So these are all the areas where you will normally look at the risk assessment. And connected to that, what type of activity? When we are talking about the nature of entity, what is the ownership structure? That's what I have talked about. And who are all the stakeholders? What is their independent thinking? For example, when we are doing an audit of owner-oriented business, where the promoters have actually put in the money, our risk may be little limited. Where they have borrowed money from the banks and financial institutions, the risk is little added. Where they have gone for IPO, listed company, the risk is actually increased because a lot of other stakeholders are coming in. Similarly, in a private company where there is a private equity investors are coming in or other investors are making money, their expectation is also to be taken care. It is not only just promoters' expectation. So, depending upon the nature of industry, our complexity also increases. The objective is what is the business risk, how the management manages the business, and how they are ensuring that there is no material misstatement. It's the areas where there could be a possible misstatement which may come in. And of course, relating to the accounting policy, selection and application on a consistent basis, a right accounting policy, whether the accounting policy adopted is appropriate, whether it is consistently adopted, whether it is aligned with the accounting standard applicable to the particular entity. So that is what we are looking for. Financial performance, how the review of the performance is being done. In fact, nowadays, because of the increased level of requirement on regulatory, we are now asking the management to provide their budget number with the actuals and what is the variance between budgeted number and actuals and what is the reason for maybe underperformance or overperformance. How it is smelling good is what we are looking at. So we can do the risk assessment and mitigate in case if there are some regulatory onslaught coming onto that. And we can actually do by means of our audit approach, by means of top-down risk approach. What are all the top risks which may lead that financial statement containing a misstatement? Address those items by means of very rigorous audit procedure and then look for the other areas, topmost risk, etc. Key risk, what we call that. And what is the business drivers? Like I have taken simple example of export, capital oriented, labor oriented, like that. What are all the key business drivers relating to that particular company? If you are talking about a retail shop, maybe a textile or maybe a jewelry retail, we always look at the cash and carry is one of the issue and the inventory risk, obsolescence could be another issue, which we are normally look at when the taste of the stakeholders are actually going out. Okay. And what are all the things which may lead to risk of material misstatement? ROMM is nothing but risk of material misstatement. And this, what we have said that you link it to the assertion level. Decide what is your audit procedure you have to perform. And based on that audit procedure, how you can do it. Okay. Up to that procedures performed is fine. And still, I have a strong belief that we never make an error with respect to our activity. We have actually completed that work. Where we normally miss it, that our audit documentation. Because audit cannot give an absolute assurance. It is only giving a reasonable assurance. And majority of the cases, we are actually using some judgmental areas to conclude on a particular item because the evidence which we are having or receiving is based on test checks. And again, there is an inherent risk with respect to accounting system or internal control system. And again, the evidences which we are collecting is not completely giving a comprehensive conclusion. This is right, this is wrong. They are not giving, they are only giving some sort of circumstantial evidence, in other words, persuasive evidence. We can reach this conclusion based on our judgment with the audit evidence which we have collected. So in that case, how I can give an absolute assurance, how I can say that I have not carried out 100% audit, but I have done a test check based on which I am forming an opinion. I made my judgment. That is the reason why I have concluded that there is no material misstatement. How it can actually known to the regulators or the compliance officers who are questioning us only if you are maintaining a proper documentation. But majority of the time, we normally miss it. What we miss it is that the expectation is, suppose if I'm not the auditor, you are the auditor, and I am going to review your work papers, I should reach the same conclusion like what you have reached without even asking a single question to you by seeing your work paper. But in reality, we might have done all work, whether it is a statutory audit, a tax audit, or any other, even certification work, everything we might have done it, but we don't maintain proper documentation. Unfortunately, the regulators are looking, or maybe the even Ministry of Corporate Affairs, even the institute is also always thinking that, even the stakeholders are also thinking that if there is no documentation, it is presumed that you have not done any work. So think about that. You are doing the work for almost a month or 2 months and giving an audit opinion based on your audit approach. And afterwards, somebody is questioning you 2 years down the line, saying that there is a fraud or there is a mistake in your financial statement. How you have to support your stand, right? How you can support your stand only based on your work papers. But if your documentation is not proper, how you will be able to withstand the onslaught? That is the question which we are having. How we can withstand this onslaught? We could do this. What? Contemporaneous documentation. During the course of the audit itself, do your documentation. Because majority of the time, what we have seen is, after 2 months or 3 months, we are going back to collection of certain documents. We will not have collected what is required to form an opinion also. We might have formed an opinion, issued it. But subsequently, when we wanted to strengthen our document, we might have found out that there is an error. Okay. So the contemporaneous documentation simultaneously during the course of the audit is desirable way of looking at. And again, end-to-end clear documentation. When I'm saying end-to-end means from start to finish, from planning to completion of your audit report. Please maintain clear documentation. For example, when you are doing an audit, first of all, for example, if I'm just checking whether the depreciation has been properly provided for, how I have to have a clear end-to-end documentation. First of all, what is my test objective? The test objective is the company has provided depreciation as required by Schedule 2 to the Companies Act. The company has considered depreciation for income tax as per Section 32 of the Income Tax Act. The difference between the two has been considered for the purposes of deferred tax calculation. And current tax provision has been properly done from memo of income tax adjustment. This is my test objective. Very clear why we are doing this. And for doing this, what are all the things which we have to identify? What can go wrong? That is what misstatement. Mistakes which can go, or the mistakes or errors is called misstatement. Okay. Where it can come, maybe the company might have adopted a wrong depreciation policy. Instead of 10 years of useful life, it might be using 20 years of economic useful life. Or the company has not followed Schedule 2. The company has capitalized revenue expenditure as capital expenditure, fixed asset, or what is they have supposed to charge as revenue expenditure, they have wrongly done it. So all those things could be the possible misstatement which you have to define for the benefit of the team members who are going and doing that activity. And for doing this, what are all the procedure you have to perform? For example, what we can give an example, re-performance of the depreciation. So opening balance has been taken from the previous year audited statement. Additions and deletions have been tallied, verified documents for major items on a test check basis. The economic useful life adopted is in accordance with the Schedule 2, or if there are any changes, whether proper disclosure has been made, and based on which whether the depreciation calculated has been really calculated, you re-perform the calculation, identify that the closing balances has been properly disclosed, depreciation has been properly disclosed. These are all the procedure which you will perform by means of this. And when you are doing this procedure, what are all the errors you have identified? Errors, what I'm saying is an exception. It may be an error by mistake, or maybe arising out of intentional error, which we call it as a fraud. So identify the exception. For example, depreciation as per your performance comes to 10 lakhs to be additionally added, but the company has accounted a depreciation of less than by the short by rupees 10 lakhs. Then that is an exception. That exception you have to evaluate whether the company has to pass an entry for 10 lakhs or it is not a material number to the company. For example, if the company is making crores of profits, 10 lakhs is not material according to SA 320 on materiality. Okay, you evaluate whether it leads to a material misstatement or not. Based on your conclusion, you will decide whether your audit report has to be qualified or normal audit report. In all these areas, maintain end-to-end clear documentation. Nobody can challenge you in any court of law or in any proceedings. When we are talking about materiality, we people always feeling that 100% I have to do an audit. There is no concept of materiality. For example, the standard on materiality says that anything less than 5% of the profit before tax for a profit-making entity is not going to influence the decision of the users of the financial statement. That is what they are talking about material, right? Only if the decision of the users will get changed, then there is a requirement for looking at an adjustment. That is considered as a material misstatement. So we have to look into how we can do that. In fact, I have seen in all the mid-size and bigger audit firms, they are very efficient and effective because they set the materiality as a starting point of planning, and then they are proceeding with identifying what are all the items to be audited, what are all the items to be not audited, scope in, scope out, but maintaining proper documentation. Missing materiality will lead to over audit or maybe under audit. So that's a which item which we have to see. Going concern is another issue which we have already discussed. I'm just taking an example of company continuously making losses, but still company's financial statement has been prepared on a going concern basis. What is the management assumption? How the auditors have evaluated that it's still acceptable, whether any reporting requirement comes out of modification in the auditor's report or in CARO you wanted to mention. These are all the things which we normally miss and get into a problem. If you are looking at a going concern assumption, validate that properly, it is not an issue. In fact, SA 570 very clearly gives you a guidance of what you have to do with respect to going concern assumption. It is very important in the present scenario of what we talk about uncertainty relating to the business is still going around. Maybe for another 6 months or 1 year, it may continue because of the COVID situation is not completely out of the world, right? So to that extent, we have to be little careful in observing our activity relating to this, and that will ensure that we are not getting to the onslaught of the regulatories. Fraud risk is another issue. I have just listed out the various aspects where there could be a possibility of issue. I normally make an industry benchmarking for all my clients. For example, when I am doing an audit, I see for a similar industry, another company, how they have performed. Why my company has performed exceedingly well or exceedingly poor. Both could be possible fraud, management fraud, or possibly management has been cheated by the employees. Could be a possibility. Whether the numbers smell good, why should I look at whether numbers are smelling good? Very simple. Every number in the financial statement has a relationship in another item. For example, if you are talking about sales, automatically sales has a relationship with my debtors. If sales is increasing, debtors may also increase. Sales is not increased, it is gone down by 50%. My debtors has increased by 100%. There is something wrong, or it is not smelling good with respect to debtors for me. But that means you are not able to collect your debtors. So find out the possible relationship between two elements of the financial statement and how the numbers will really smell good for you as an auditor. Very simple. Use your common sense. Nothing to worry about your laws, regulations, your accounting standard, auditing standard, etc. Your common sense will tell you something is wrong here. I still remember that when I did my articles for the first year, when I finished a partnership work and brought that financial statement very proudly, thinking that I have covered the entire thing and presented that financial statement, maybe in 1984, if I'm not wrong, when I had given to my auditor for the first time, the auditor looked into that financial statement hardly for 2 minutes and said, there isn't something wrong in this financial statement. Maybe your purchase is not properly accounted for, or your closing stock is not properly valued. Look at the outturn, that is the input output ratio, and come back to me. I was wondering, he has not even looked at the books of accounts. How the auditor has just looked at the numbers are smelling good. When I went back and I found that yes, there is a problem in the closing stock valuation. And based on that, we have revised the statement and went back. And then I have asked the auditor, sir, how you have identified, you're not looked into my work papers, you are not looked into the stock books, how you have identified? Very simply, he said, your gross profit margins for this particular company, when I compare with the other companies for the current year, is so much. Last year, they have done that percentage of gross profit. This year, the percentage has dropped a significant level. There is something wrong. This company, we need not worry that there is a fraud, but there could be an error because the management may not have a qualified accountant to do the entire activity. So we have to validate the correctness of purchase being accounted and the sales being properly accounted for, closing stock has been properly captured. In the issue, we have seen that the closing stock valuation was wrong. Once we have done it, the gross profit is benchmarked with the other companies in the same year, as well as the previous performance of the company. So that is where you can identify using your common sense, your experience, your expertise, understanding of the client's business, how the numbers are smelling good or not. Standalone financial statement shows profit, consolidation makes a loss. That means you are having a lot of luggages which are not good. Your investment in your subsidiaries are not good. Sometimes promoter shareholding is very, very thin. For example, in Satyam case, the promoter shareholding was less than 10%. That is the reason why there is a pressure of performance by the promoters to maintain that the company is with the same promoters and they are continuing as the board of directors and chairman. So that will also lead to an assessment whether promoter shareholding being thin may result in a material misstatement. We assess that. We are not thinking that automatically it will become a fraud. We are thinking that there could be a possible fraud risk. And for that, how we are doing our audit procedure. For which necessarily your professional skepticism, questioning mind, not taking anything for granted could be possible. Nowadays, I'm seeing one issue which is creeping in. When we are assigning the job to our article students or our juniors and asking them to carry out certain activity, they are going to the client place, client is saying something, they are coming back with that conclusion, what client has said. When I raise this question, why this is not validated? Sir, I asked the question, my client, and client has answered this, so we have closed this issue. Client sometimes will know that particular item or client may not have the full information with them. So in that case, have we accepted on a blind basis or we have validated? That is also important. Now your transactions are becoming complex. Previously, we just have a sale, collection, cash sales, credit sales. Now we are talking about export sales, LC. We have forward contract. Business are becoming more and more complex. If it is becoming more and more complex, how we are managing that is another issue. Wherever there is a related party transaction, we have income tax related transfer pricing issue. We have issues under the Companies Act. We have issues relating to SEBI, if it is a listed company. Looking at whether the related party transactions are structured in such a manner to do certain fraudulent financial accounting, right? So you have to be careful on related party transaction and you have to do certain activities on that. Whether a particular transaction has been done outside the normal course of business. I have seen one case where the unbilled revenue relating to a project company has suddenly gone by 300%. And the profit for the sales for the particular year has also gone by 200%. When we were asking the aging of the unbilled revenue, and also when subsequently unbilled revenue has been actually billed on the customer, we have found out that certain entries have been passed based on the purchase order received, not even the work has been performed. So when you are doing this type of activity, what are all the major items, whether anything which has happened outside the normal course of business to accommodate higher turnover and higher profit to show the performance of the company is in a rosy manner, you have to always look into any transactions are coming out of the normal course of business. Fraud risk and management override of controls, I have already discussed. It is operating for 364 days, and last day there is an expectation. I still remember that in one client case, in the first quarter itself, we have resigned because the expectation for the first quarter results, the CFO came and told us that, sir, you can do your audit, you can do whatever requirement, we will provide all the evidences, etc. But this is the profit. This is the EBITDA, 2 decimal lakhs of rupees, he has said. This is what we are going to show. When he has already decided that number, I have to validate. And he has indirectly communicated to me, if you are coming out with an audit adjustment, we will also expect you to find out a credit for that particular entry. Indirectly, he has communicated. That is not my role. When that is the management override of control, why should I continue be the auditor of that particular company? Instead of being comfortable without meeting the onslaught of the regulatory perspective, I can comfortably live my life peacefully, right? Looking at genuine clients, even they are smaller in number, we can do the better job, right? So you have to be very, very, very clear on your fraud risk assessment. Judgmental area, subjective area, how the management has taken this view. Is it acceptable? Is it within the laws and regulation? Is it in accordance with the accounting standard? Whether you can get an audit evidence to support that particular judgmental view. These are all the areas by which you can carry out your fraud risk assessment to the fraud risk to the lowest acceptable level. Brought it to the lowest level, material misstatement will not be there. Because the audit approach is completely going in a different perspective. The traditional approach is process risk, control-based approach, etc. Now it's business risk. What is the risk relating to the business based on which we are doing the audit? We do a periodic and audit plan-based approach. Now we are real-time business cycle-based approach. We are changing our audit procedure. Control, how it can be enhanced is a focus. Now we are trying to find out by means of our audit, can we suggest something which can enhance the business performance of the company? That is the focus which we are having. So the audit role is completely changing. In fact, we were, just to take this particular example, in many of the companies which we are doing the audit, we are now started using data analysis. So, for example, when we are doing the ledger review and coming out what is our observations on the ledger review, it takes 1 month for us to complete the entire ledger review for bigger clients. Now, 100% of the data is taken and used in Excel and other data analytic tools are available, where we can actually find out 100% of the data analysis based on what are all the audit questions you will ask. Put it in automation. That gives you an exception list. Concentrate on the exception list and then do your audit procedure. That is exactly what we are trying to do. Just see, the volume of information in the past is small and presently it is reasonably going up. Future it will go up. The volume of information which is coming for the audit is so high. Data, the number of line items, number of entries, number of complexities will be possible. And the complexity of that information, previously it is very, very normal, not very, it's not complex at all. Now the complexity is significantly increasing, and in the future it is going to increase significantly unless you are thinking about converting data into meaningful information and deriving out what you can do it. You cannot do a bigger audit. As far as smaller audit is concerned, tally-based audit, you can do it. But if you are doing an audit of a bigger companies, you have to understand that data analysis is also another important when it comes to fighting before the regulatory onslaughts. That is what we are talking about, how you can get the data and do your audit needs. Your test objectives can be done, exceptions can be drawn out. those exceptions can be actually looked into by the audit team by looking at in detail the data by performing additional audit procedures. When we are talking about audit report consideration, we have a lot of things which we are having. To put it in simple terms, should be according to accounting standard. The disclosure should also be sufficient for the users to define. If both are missing, it may result in a qualification. That is exactly what it is actually talking about. The entire procedure is talking about. So you have to not necessarily look at the accounting policy being properly adopted. The disclosures are being made according to the standard. Now the disclosure is also to be according to Schedule 3 amendment. Very recently, Institute has come out with a guidance note on non-corporate entities, what should be the financial statement. So to that extent, the format which we are now doing may undergo a little bit of changes, but that is what the expectation from the regulators or compliance agencies which they are looking for the auditors to do. How we can manage all these things? There should be a time for specialization. This is the time for specialization or industry specific partners should look into. If I'm saying I'm the master of all arts, we may fail. We may have more talents to be brought in. I've seen young talents are so good in data analytics in a particular area, and each partner, when they are taking up the activity on specialization. For example, in one of the client cases I have seen, there are 7 brothers in the family business, and each one is concentrating on one activity of the business. They are not disturbing each other. For example, purchases decided by one particular brother. Sales and the pricing is decided by another brother. The entire accounting is being taken care, accounting, filing with income tax department, GST is being coordinating with the auditors, internal auditors being taken care by the third brother. And maintenance of all the assets is taken by the fourth brother. Production is being taken by the fifth brother. And more interestingly, what is the requirement for their family is being taken by one brother. In other words, your family pressures are not going to disturb you from away or disturbed from doing your business activity. That is being given as a specialized activity. Even for a business, when they are thinking like that, for carrying out your practice, why not you think like keeping a specialization, industry specific expert partners being part of your role. And in case if you are believing that it is very difficult to have so many partners because my practice is very small, do you have a team which has at least hands-on experience for the particular client? If not, please add somebody, maybe as an outsourced activity, bring somebody, put your team members with them as part of their discussion, so that part of their procedures, so that you will be able to cope up with that particular thing, maybe in the next decision. Learning, getting developed and getting updated is always required. For example, even this virtual seminar, when we are looking at the number of participants, maybe it is not very comfortable for the organizers, right? When it is dropping, it may be not comfortable for the speakers, but we are talking about one of the very important aspects relating to the audit. So how you can get your knowledge and learning and development can happen, maybe virtual seminars and other seminars, because we don't have time to do it. Investment in technology, all these things are the way forward by which you can do it. So I believe that unless you use technology, you use talents, it is very difficult for you to balance of the public pressure and stakeholders' expectation, the social consideration, the environmental consideration, how you can manage the regulatory expectations, and in case if you have been thrown out with any penalty proceedings or any proceedings, able to withstand that type of thing is all only by taking care of what is your expectation, how you are planning and executing to meet the expectation, how you are equipping yourself further and further is what I believe is part of that. With that, I will end my session. If there are any questions, I will take those questions, and I stop the presentation. Of course, my contact details will also be part of this. And any questions, I will be happy to take those questions in case if there are any. Over to the moderator also, sir.